March economic growth for the first quarter of 2016 came in at just 0.5%. But take that number with a large grain of salt. The economy is better than the GDP number would have you believe. First quarter GDP growth was anemic, just 0.5%, but the consensus forecast of about 70 economists surveyed in early April by the Wall Street Journal was for GDP growth in 2016 of 2.4%. Check this out. The U.S. economy has experienced seasonal weakness in the fourth and first quarters since the Great Recession, and this pattern seems to be unfolding yet again in 2016. For example, the GDP growth rate was just 0.6% in the first quarter of 2015, but it was followed by 3.9% growth in the second quarter of 2015. The seasonal pattern is expected, and the consensus forecast for much stronger growth in the second, third, and fourth quarters of 2016. Is it reasonable to assume the consensus forecast of economists is correct? Can this 6.5-year-long economic expansion really continue? Happily, the answer is yes. While economic growth is affected by seasonal swings, consumer spending drives the U.S. economy, and that is in good condition. Let's drill into the data to see how seasonal swings can affect the economy. The U.S. economy's gross domestic product is driven by these four elements. Consumers buying services, by far the biggest driver of growth, is not very cyclical. Compared with the big swings in the investment account, personal consumption stays in a tighter band in this period, dating back to the beginning of 2003. How did the plunge in investment affect the U.S. economy through the Great Recession of 2008 and 2009? Based on data compiled by Fritz Meyer, an independent economist, whose research we license, gross private domestic investment is actually only 17% of the total GDP. Swings in the investment account are not so influential on the long-term growth trajectory of the economy. Consumer spending is the big engine of growth, and consumer spending is driven by two key factors: population growth and consumer income. These two key factors of growth are rising. Disposable personal income has been in recovery for over 5 years. On Friday, April 29th, the government reported disposable personal income growing at a very impressive rate of 4% a year. Disposable personal income was only slightly lower than it was during the last economic expansion, the debt-fueled boom of the Great Recession of 2008. Because personal spending is responsible for 69% of the economy, the rate of change in personal spending is key to the rate of change in GDP. In the 2008-09 recession, personal savings surged. After hitting pre-recession lows, the savings rate boomed, and it has remained substantially higher than it was before the global financial crisis. To be clear, in this economic expansion, we're seeing consumer spending rise, and it is not fueled by debt like it was the last time. As May 2016 began, the Standard & Poor's 500 stock index was only about 4% off its all-time high. Stocks have been more volatile in recent months, with two double-digit corrections in August 2015 and again in February 2016. More volatility is certainly possible. While there is no assurance stocks will be pushed higher, economic data suggests that the economic expansion will continue through 2016, and that is a fundamental support for stock prices. That's why we're telling you to take weak first quarter 2016 GDP data with a large grain of salt.